Hello everyone and welcome back to Finance at JCL, a show here to help you on your investment journey and to help you achieve financial freedom. And thank you very much for taking some time out of your day to be with me on this one. And you're not going to want to miss this because this is all about Google. This is a company review, so I'll look at their fundamentals and then perform a valuation. So it could be an exciting one. It's been requested by Fabrizio, one of my subscribers. So if you'd like to see any particular companies in my next review, please drop a comment below and I will have a look at that for you. The key objective for today, I want to review the key fundamentals of Alphabet, which is the kind of overall holding company for Google. I'll then decide for me if it's a suitably strong company for a long-term investment, because that's the lens with which I invest with. And then if I've decided it's a potentially suitable investment, then what is the buy price to include that key margin of safety? And that will be based on the free cash flow generation and how I calculate that for Google over a period of time. And I'll have that margin of safety of 50%, because that means then if my calculations are wrong, I've got some protection and there's 100% upside if I'm buying something on a 50% discount. And then kind of the question linked to that then is, will I be buying this stock now? And then a quick disclaimer, I'm not giving you financial advice here. This is just for entertainment and educational purposes only. I'll be doing the review based on how I look at the shares, but you should take your own advice and do your own review before making any purchasing decisions. So the valuation considerations we look at today, I'm actually going to present this slightly differently to some of my previous videos. I've got more of a visual format, which I think will be easier to follow. So you'll see on the right, I've kind of got like a radar chart, a bit of a pie chart, and I've got the key categories that I'm going to talk through today. And you'll notice towards the middle, kind of in that bullseye area, there's some red sections. And if on my analysis of Google, I find that they fail to kind of meet at least that red section, then I'll not be investing. So that's kind of the mandatory criteria. You'll see that as we go through. Let's move on. So we'll start with free cash flow, which is absolutely a key element for me whenever I review a company. Now, first of all, the free cash flow must be positive. I've got a green tick there, so it is. So Google passes that mandatory test. And a very desirable position is that the CapEx requirements are very low. So the business will generate operating cash flow. You take the CapEx off, and then you're left with the free cash flow, which is kind of your owner's earnings, if you will, if you were to own the company. And Google has quite a lot of CapEx. It's not excessive, but it's kind of 40 to 50% of its free kind of operating cash flow becomes taken to CapEx. That reduces the free cash flow. So it's okay in that regard. But the trend for free cash flow is increasing. So every year it's increasing the amount of free cash flow it generates for the owners of the business. And the actual numbers there are really, really large. So I've actually given it full marks there. So you'll see the green segment on my chart on the right. So it's a good start. So then move to the net income. And again, the net income has to be positive for me to consider it as an investment. And it is for this company. Now, I would desire an average of over 20%, and for Google, the 10-year average is not weighted average, but 10-year simple average is 22%. And the trend of net income is increasing, so it's still a company that's increasing its profitability every year. So again, it will get full marks for that section. It's looking good so far. So I'd then like to look at the revenue, and the trend of revenues increasing, and there's some very big numbers there, full marks. So what this first kind of quadrant is showing, this first quarter rather, is it's a company that's growing in cash flow, net income and revenue. So it's still getting bigger, and those numbers are very big and very positive. From that perspective, it's looking good. There's probably still some future growth in the company. So then move kind of onto the ability to survive in the short to medium term. So I start with the current ratio, which is the relationship between the current assets and current liabilities, and it absolutely for me has to be above 1 to consider investment, and it is. It is actually 3.41, so it's well above my desirable level of above 2. So again, looks very strong. Now the trend is actually dropping down over 10 years, but the number's so big anyway that it gets full marks still. Debt to equity is the next one. I just popped a video up on that, so I'll link that in if you're watching on YouTube. Now with the debt to equity, the mandatory number for me, it has to be below 2, and ideally it's below 0.5. And in the case of Google, it's actually 0.07, so it's really, really small, and it's very stable. So that again is kind of full marks on the assessment criteria. We then move to the linked interest coverage. So that needs to be above 6. It's kind of ability to cover these payments. It's actually 479, so it's huge, and the interest coverage is actually increasing. So quite simply, that is full marks again. So we've looked at the first 6 categories: free cash flow, net income, revenue, and then the current ratio, debt to equity, and interest coverage. And they're pretty much, you look at full marks there. So looks like a really strong company so far. So now move on to perhaps some of the more subjective elements, so perhaps ones you can't necessarily measure by numbers, but nevertheless are important in an investment decision. So look at the moat, and there are different types of moats, which is kind of what advantage, enduring advantage or competitive advantage does the company have. And it could be that it is one where everyone knows the name. It could be one where there's kind of a social effect, like Facebook, so everyone's on it, and because everyone's on it, more people join that one rather than others. It could be the ability to manufacture at really low costs, and Google's definitely got a moat. It's very desirable for a company to have a moat. I think the best way to look at it is you Google something rather than you search for something. It has become its own verb, its own action, and I think that demonstrates there's a moat there. So I think 100% full marks on that section. So linked to that, I'll look at the industry as well. The industry is very large, the areas which Google makes its money. And will it be there in 10 years? Will it hold the share for 10 years plus? Absolutely. And I think the trend's increasing. So as more and more people around the world get mobile phones, more and more apps are developed for them, the App Store, in developing countries where mobile phones perhaps are coming in or 4G is coming in, move it to 5G, so there'll be more data consumption in some of the nations. And you've got YouTube growing. There's a lot of growth still in the industry. Full marks on that one. So then want to move to some of the things that demonstrate how management is running the company. So look at return on equity first of all. Now I like the return on equity to be at least 8%, which it is here. And ideally a long-term average of about 20%. And Google's long-term average is 16%. And the trend is steady. So this is actually the first section. It doesn't get the full marks in because that return on equity is a little bit lower than my desired number, and it's not really increasing. But nevertheless, it's well above the level for my minimum. So then move on to the dividend and shares. So there is no dividend for Google, and it's a growing company, and I don't mind that. My thoughts on dividends are, it was great if a company paid one. If the company can use that money to grow at a higher rate of return, then you can use it as a shareholder. Why would you want a dividend? And if you look at the way Google's been growing in the last 10 years, and you look at their return on equity, and look at their margin, actually Google could probably get a higher return than them actually paying me money. And if they pay me money, it actually reduces their ability to grow. Perfectly happy with there being no dividend. And of course they could do share buybacks, but that's not really on the table at the moment. So there's no mark in that section, but that's fine. Price to earnings ratio is 31, so it's not actually as high as I thought it would be. You know, there are some companies out there in the tech sector on PE ratios of in the hundreds. Isn't the case for Google, so it gets a mark. So ideally, you know, if you've got a price to earnings ratio of below 15, it could be a company that's potentially undervalued, or it could be that the market thinks there's little growth prospects. So 31 is perhaps a bit more expensive as a number, but that it is indicating there's some growth there as well. So it's fine. I've got no issue with that. It's just an indicator rather than something I make a decision based on. And then finally, kind of price to books, another indicator of value. So there are some companies, particularly insurance companies at the moment, where their book value is actually lower than the share price. So there's potentially some gains there. For Google, it's 4.6. We expect it to be multiples, and again that's fine. You know, it's not is not excessive. It's more of an indicator. It doesn't really matter too much what it is. It's more of an indicator so that if it's really low, there could be a potential value investing opportunity. But that's not the case here. So if we conclude the kind of fundamental analysis, profitability, free cash flow generation, size of companies all growing and looks really good. The ability to survive in the short to medium term all looks really good. The industry and the competitive advantage is excellent. The ability to reinvest money is good. There's no value play here, which is probably what you'd expect because everyone knows about the companies that's probably priced reasonably fairly. So next thing I'll do is just have a quick look from Morningstar, so credit to them for this information, about the 10-year view. So I like to look at the numbers. Perhaps some people find it difficult to look at numbers in these large tables, but I like to just have a quick scan over them to see if there's any trends. You can see the net margin there is generally around the 20s, the low 20s for most of the last sort of 8 years or so. Return on assets is generally in double figures. Return on equity, it's kind of high teens. And that kind of interest coverage is really high. So there's nothing that you think, wow, there's a problem here. So I'll then look at the kind of liquidity and financial health. So as I mentioned, the current ratio has kind of dropped a bit from its previous levels, but still very high. 3.41 at the moment. Debt to equity 0.07. It's always been below 0.1, so absolutely good. And then looking at kind of the bigger financial picture, that revenue's gone from 29 billion to 166 billion. So there's a lot of growth there. And in fact, even in the last since 2016, you've gone from 90 to 166, so you're almost doubling in 4 years there. It's incredible, really. Gross margins always 50 to 60%, operating income just getting bigger and bigger and bigger every year, from 10 billion in 2010, 36 billion in 2019, really impressive. And then your net income is doing something similar. So earnings per share, $13 a share 2010, you're now looking at getting towards $50 to $45 per share now. So it's very impressive. And you see the number of shares is always 650 to 700, so I haven't really been doing any share buybacks. Book value of each share has gone from 72 to 304, so they're growing the value of the company. And you can see the capex spending is getting bigger each year as it grows, but so is the free cash flow. So that ratio is about 40 to 50% most years. And they've got loads of working capital, so the financials all look really good to me. There's nothing there that causes me any bother at all. So I kind of then thought, right, I want to invest in this company, but I want to actually look at the valuation. So I've worked out the fundamentals, but what's the value, and I can compare that to the price. So I've looked at two things. Ideally, I want at least a 10% return on a company. On a 10% return, I crunched numbers, and the intrinsic value is about $1,800 per share. So therefore, my buy price with a 50% margin of safety would be $911 per share. But that's a margin of safety over the current market price of 22%, because the current market price is about 1,400. So the market price is below the intrinsic value, but for me, being only 22% below isn't enough. So therefore, in theory, if I'm looking for a 10% return, I'm not going to buy this share at the moment. And if I dialed my thing back to a base level of return, so 6.66%, the intrinsic value then is actually $3,743 a share. So that gives me a buy price of 1,872. There's a margin of safety of 62% because the market price is 1,400 and the buy price is almost 1,900. So it's below the margin of safety threshold. So in theory, actually, if I wanted to do a 6.66% return, I would actually buy this stock because there's a really good margin of safety there for 62%. In summary, looks like a really good company. We can see from the graph if you're watching on YouTube, and it is better than some of my existing stock. The quality of the company is better than some of the stuff in my portfolio at the moment. So that suggests a switch out. However, I'm not actually going to buy the stock. And the reason for that is in my calculations of discounted cash flow, it was based on a growth rate of 16% a year, which is a really big growth rate for a company that's already very big. It could be possible, but if I'm going to almost gamble on there being a 16% a year growth rate, for the next 10 years, and it becomes a pretty big company then, well, even substantially bigger than it is today, I want a bigger reward, so I actually want the 10% return rather than the 6.66% return. Because if that 16% growth year doesn't show up, the calculations could be pretty wrong in terms of its value. I'm not actually going to buy the stock, but I'm going to add it to my wish list for sure, and it'll be right at the top of the wish list, and set up an alert. So once it hits that 900 or so buy price at the 10% growth rate, I'm going straight in and I'm buying as much as I can. So that's the end of the show for today. So thanks for joining me. If you enjoyed the video, drop me a comment below. Let me know what you liked. Did you like the new presentation style? If you're watching on YouTube, did you like the graphs? Also, if you've got any suggestions for future companies for me to review. And then if you could subscribe if you want to see the next videos coming in, that would be much appreciated. So thanks for joining me, and I will see you on the next one.